Silver crashed $40 in days. COMEX vaults are nearly empty. Silver didn't just drop, it collapsed. $42 gone in days. And the vaults that are supposed to back it all, nearly empty. But here's what nobody is telling you. This crash might be the most dangerous trap ever set in the history of precious metals, and Sunday's market open could change everything. Welcome to Currency Archive. Now, if you've been around long enough to know that markets don't always tell the truth, you're in the right place. Do us a small favor, the kind you'd do for an old friend. Hit that subscribe button. It costs you nothing, but it means everything to us. And before we dive deep into what's really happening inside these vaults, tell us in the comments, where in the world are you watching from today? Because what's coming next, you'll want your people to hear it too. It started with a number, a single price on a screen, and for most people, scrolling through their phones that Friday morning, it meant nothing. But for those who had spent years watching silver, really watching it, that number was a flashing red alarm that something had gone terribly wrong. Silver had crashed $42 in just a matter of days. Not weeks, not months, days. And the vaults that were supposed to hold the physical metal backing all of this were nearly empty. There was a trader in New York. He had been in the precious metals market for over 2 decades. He had seen crashes before. He had seen manipulations before. He had watched silver get knocked down more times than he could count. But that Friday morning, he sat at his desk and stared at his screen with a look his colleagues had never seen on his face before. It wasn't panic, it was something worse. It was recognition. He had seen the early signs building for weeks, the vault numbers dropping day after day, the Shanghai premiums climbing higher and higher, the paper claims piling up against a shrinking pool of real physical metal. And now the crash had arrived, exactly as the data had suggested it would. He picked up his phone and called a colleague. "Do not sell today," he said quietly. "Whatever you do not sell today." To understand why that warning mattered so much, one has to understand what had been happening beneath the surface of the silver market for months. On paper, everything looked normal. Silver was trading, prices were moving, the exchanges were open, contracts were being bought and sold by the millions. But underneath all of that paper activity, something deeply unusual was developing. The registered silver inventory at COMEX, the vaults that hold the actual physical silver that backs all of those paper contracts, had been draining at an alarming rate. Every single day, more silver was leaving those vaults than was coming in. 785,000 ounces per day. Day after day after day. And by that Friday morning, the registered inventory had fallen to just 98.1 million ounces. It had crashed below the critical 100 million ounce threshold for the first time in years. For veteran market watchers, this was not a small detail. This was the foundation cracking. At the same time that the COMEX vaults were draining, something extraordinary was happening on the other side of the world. In Shanghai, physical silver was not trading at $78 per ounce like the Western paper markets were showing. It was trading at $130. That is a $52 difference between what a piece of paper in New York claimed silver was worth and what a real physical bar of silver was actually selling for in Asia. This kind of gap, called a premium, does not develop overnight. It builds slowly, quietly, as real buyers with real demand start paying real prices for real metal. And by that Friday, the premium had grown so large that it was impossible to ignore. Industrial buyers in China were not waiting for Western markets to set the price. They were paying whatever price was necessary to secure the metal they needed. Solar panel manufacturers, electronics factories, electric vehicle battery producers, none of them could afford to stop their production lines over a weekend. So they kept buying. At $130, while Western paper markets showed $78. Back in New York, the trader who had made that early morning phone call was now pulling up one more data set. March contract open interest. 429 million ounces of paper claims, against 98.1 million ounces of real physical metal in registered vaults. He did the math slowly, deliberately. 5 paper claims for every single ounce of real silver. He leaned back in his chair. First notice day for March contracts was arriving in exactly 7 days. 7 days, and the vaults were nearly empty. He looked out the window at the New York skyline and thought about what Sunday's market open might look like. Whatever was coming, it was already too late to stop it. Nobody planned to be here. That's what made it so dangerous. Not a single analyst, not a single portfolio manager, not a single institutional trader woke up one morning and decided to build the most precarious silver market setup in modern history. It happened slowly, quietly, one contract at a time, one vault withdrawal at a time. Until one Friday morning, the entire structure was standing on the edge of something that very few people in the world fully understood. And the ones who did understand it weren't talking publicly. There's a concept in markets that experienced traders call a coiled spring. It describes a situation where pressure has been building silently beneath the surface for so long, in so many directions, that when the release finally comes, it doesn't drift, it explodes. By that Friday, the silver market was not just a coiled spring. It was a coiled spring that had been wound tighter and tighter for months. While someone kept quietly adding more pressure from directions most retail investors never even thought to check. The first layer of pressure was the vaults. The second layer was Shanghai. But the third layer, the one that made seasoned traders go quiet when they discussed it, was something far more deliberate. It was the overnight attack. In the hours before most Americans had even made their morning coffee, something coordinated had already happened inside the silver futures market. 633 institutional accounts, moving together. In the pre-dawn hours, when trading volumes are at their absolute thinnest, when a relatively small number of contracts can move prices dramatically, these accounts added approximately 8,400 short contracts to the market, all at once, all in the same direction, downward. This is not normal trading behavior. Normal traders do not all move in perfect coordination at 3 in the morning when liquidity is at its lowest point of the entire trading day. This was engineered. It was designed to push silver prices to the bottom of their recent range before a very specific event. That event was the PCE inflation data release that morning. The PCE, personal consumption expenditures, is the Federal Reserve's single most important inflation measurement tool. When that data printed at 2.9%, exceeding the forecast of 2.8% and rising from the previous reading, the coordinated short sellers had a problem. They had pushed silver prices down in anticipation of data that might justify their short positions. Instead, the data confirmed the opposite. Inflation was not cooling, it was accelerating. And the Federal Reserve, the institution responsible for controlling that inflation, was now caught in a trap with no clean exit. It could not cut interest rates. Cutting rates while inflation was rising at 2.9% would destroy the dollar's credibility and trigger a crisis that would make 2008 look manageable. It could not raise interest rates further. The banking system was already under severe stress. Commercial real estate defaults were mounting. Regional banks were bleeding. The federal government was already spending over $1 trillion annually just on interest payments alone. The Fed was frozen. And when central banks freeze while inflation runs, historically, only one asset class has ever truly protected ordinary people from what comes next. Hard assets, physical silver. Back inside the trading floors, the 633 accounts that had coordinated their overnight short attack were now sitting on positions that the morning's inflation data had just turned against them. Every short contract they had added in the darkness of pre-dawn trading was now a liability, because short positions must eventually be closed, and closing them means buying. Buying that adds upward pressure to an already explosive setup. They had meant to suppress the spring. Instead, they had compressed it further. A veteran metals analyst watching the data that morning described it simply to a colleague across the desk. They didn't break the market, he said. They loaded it. And somewhere in Shanghai, physical silver was still trading at $130, while New York showed $78. The gap wasn't closing, it was widening. And first notice day was now just 6 days away. Markets close, but the world doesn't. That is the single most misunderstood truth in all of precious metals investing. And that Friday afternoon, as Western exchanges shut their doors at exactly 1:30 p.m. Eastern, as traders logged off their terminals, as portfolio managers headed into their weekends thinking the market would simply pause and wait for them, physical silver kept moving, quietly, relentlessly. Across 52 uninterrupted hours of global trading that most Western investors didn't even know existed, picture a dealer in Hong Kong. It is Saturday morning. The sun has barely risen over the harbor. His phone has already been ringing for 2 hours. Industrial buyers, procurement officers, sovereign fund representatives, every single one of them asking the same question. How much do you have? And what is your price? He doesn't give them the COMEX paper price of $78. That number means nothing to him. That number means nothing to any physical dealer operating in Asia over the weekend. Because in his world, the world of actual metal, actual delivery, actual industrial necessity, silver is trading at $130. And his inventory is moving faster than he has ever seen it move on a weekend. This is the reality that most retail investors sitting in America never fully grasp. When Western paper markets close for the weekend, they are not closing silver. They are only closing the paper version of silver. The real metal, the bars sitting in warehouses, the kilobars changing hands between industrial buyers and dealers, the sovereign acquisitions moving through bilateral government agreements, none of that pauses for a Saturday or a Sunday. Chinese solar manufacturers need silver to keep their production lines running through the weekend. Electronics factories don't schedule their production around the New York trading calendar. EV battery producers operate around the clock, 7 days a week, because their customers demand it. These industrial consumers were not calling dealers on Saturday morning to ask about prices. They were calling to confirm quantities. Price was secondary. Supply was everything. And supply was the problem. Because while physical buyers across Asia were sourcing metal at $130 per ounce throughout the weekend, the registered inventory sitting inside COMEX vaults was not being replenished. At the drainage rate of 785,000 ounces per day, the math was brutally simple. By Monday morning's vault report, registered inventory would fall to approximately 92 million ounces. By first notice day, now just days away, it would approach 85 million ounces, against 429 million ounces of outstanding paper claims. 5 paper claims for every single physical ounce, a ratio that had never been tested during a major delivery month in modern market history. Then came the news that changed the weekend calculation entirely. The Shanghai Futures Exchange had been conducting a quiet but significant enforcement operation during the Lunar New Year holiday period. They had identified 6 separate clusters of coordinated trading accounts. Accounts that had been systematically suppressing silver prices through concentrated short selling during the holiday, when volumes were thinner, when resistance was lower, when manipulation was easier to execute and harder to detect. The exchange banned them all, every single account, gone from the market before the weekend began. For years, these coordinated sellers had been applying invisible downward pressure to Shanghai silver prices, a constant artificial weight pushing against what physical market dynamics were demanding. And now, without warning, that weight had been lifted. One analyst described it with a single precise image. "Imagine holding a beach ball underwater for months," he said quietly, "and then one Friday afternoon, you let go." The geopolitical situation added a dimension to the weekend that no probability model could fully capture. Over 50 fighter jets had been deployed to the Middle East. Iran had conducted partial closures of the Strait of Hormuz for naval exercises. Vice President Vance had stated publicly that Iran was refusing to acknowledge administration red lines. Military planners have understood for generations that Friday evening is the preferred window for launching operations. 48 hours of battlefield development before markets reopen, 48 hours for a situation to transform completely before Western traders log back into their terminals Sunday evening. The silver market was sitting at the intersection of a physical shortage crisis, a paper market trap, a manipulation vacuum, and a geopolitical powder keg, all 4 simultaneously, all 4 over the same weekend. And somewhere in a quiet office, a veteran metals analyst was running one final calculation before closing his laptop for the evening. He pulled up the Shanghai premium data one more time. $52 above Western paper prices. Physical silver at $130. COMEX paper at $78. He stared at the number for a long moment. In his entire career, he had never seen a divergence this large, persist this long, with this much physical pressure building behind it. Divergences this extreme don't last forever. They resolve, sometimes slowly, sometimes gradually, but sometimes they resolve in a single Sunday evening, in the first 60 seconds after Globex reopens, when every buyer and every seller discovers simultaneously that the price they thought they knew no longer exists. He closed his laptop, set his alarm for Sunday at 5:45 p.m. Eastern, and waited. Sunday evening arrives differently when you know what to look for. Most people see a quiet night, a few hours before the work week begins, maybe a meal with family, maybe a television program, maybe an early bedtime before Monday's routine restarts. But for a very specific group of people scattered across time zones, traders, analysts, vault managers, institutional desk operators, Sunday evening at 5:45 p.m. Eastern is not quiet at all. It is the most important 60 seconds of the entire week, because that is when Globex reopens. And that is when paper prices must finally face the physical world that kept moving without them for 52 uninterrupted hours. Picture the scene inside a trading desk somewhere in Manhattan. The screens flicker back to life. Fingers hover over keyboards. Nobody speaks, because in that room, every person already knows what happened over the weekend. They know physical silver traded at $130 throughout Saturday and Sunday across Asian dealer networks. They know the Shanghai premium didn't shrink during the closure, it widened. They know the geopolitical situation didn't de-escalate, it intensified. They know the vault drainage didn't slow. The Monday morning report will confirm registered inventory has fallen again. And they know that 429 million ounces of paper claims are still outstanding against a registered inventory that is collapsing toward 85 million ounces, with first notice day now less than a week away. Every single person in that room knows all of this, and yet they wait. Because knowing and seeing are 2 entirely different experiences. The first trade prints, and the number on the screen is not $78. The room exhales in a single collective breath. This is the moment that veteran precious metals analysts had been describing for months in careful, measured language. The convergence. The point where paper prices can no longer sustain their artificial distance from physical reality, where the $50 gap between what COMEX claimed silver was worth and what Shanghai was actually paying for it begins closing violently and instantaneously. Gap opens are not gradual. They do not drift politely higher while giving late sellers time to reconsider. They open where the first willing seller meets the first desperate buyer. And on this particular Sunday evening, the sellers are scarce and the buyers are everywhere. Think about what this moment means for the ordinary investor who sold their silver position Friday afternoon. They sold at $78. They told themselves they were being prudent. They told themselves they were avoiding weekend risk. They told themselves the uncertainty wasn't worth it. And now they are watching a screen show them a number that is dramatically higher than the price they accepted 52 hours ago. They didn't avoid risk. They transferred it. They handed their upside to the institutional accounts that coordinated the overnight short attack, that suppressed prices into the PCE data release, that manufactured the weakness that made selling feel rational on Friday afternoon. Those 633 accounts are now covering their short positions, buying back contracts at higher prices. The very buying pressure created by their short covering is accelerating the gap higher. The trap was not set for silver. The trap was set for the retail investor who believed the paper price on Friday afternoon told the truth about what silver was actually worth. There's a particular kind of silence that falls over experienced market participants when they witness a repricing event they had calculated but still find extraordinary to observe in real time. It is not celebration. It is not surprise. It is something closer to a deep, quiet understanding that markets, eventually, inevitably, without exception, tell the truth. Paper can diverge from physical reality for weeks, for months. Institutional coordination can suppress prices through manufactured selling pressure in thin liquidity windows. Exchange manipulation can hold an artificial weight against what fundamentals demand. But 429 million paper claims cannot permanently pretend that 98 million physical ounces are sufficient to back them. Not with 785,000 ounces draining from registered vaults every single day. Not with Shanghai paying $130 while New York showed $78. Not with first notice day arriving in days rather than weeks. Not with industrial buyers across Asia sourcing metal around the clock, regardless of what any Western exchange chooses to display on a screen. The veteran metals analyst who had set his alarm for 5:45 p.m. Eastern watches the opening trade print from his home office. He doesn't reach for his phone. He doesn't call a colleague. He simply sits with the data in front of him and thinks about the thousands of ordinary investors, people over 50 who had worked their entire lives, saved carefully, positioned themselves thoughtfully in physical silver because they understood that paper currencies were being debased at 2.9% and accelerating. He thinks about the ones who held and the ones who didn't. Then he opens a blank document and begins typing the only sentence that feels accurate after everything that just unfolded. The market didn't lie to you on Friday. It just hadn't finished telling the truth yet. 7 days. That was all it took from the moment registered inventory crashed below 100 million ounces to the moment paper prices began their violent convergence toward physical reality. 7 days. 98.1 million registered ounces. 429 million paper claims. $52 Shanghai premium. 785,000 ounces draining daily. 633 institutional accounts whose short covering became the fuel for the very move they tried to prevent. And a weekend that the paper market tried to ignore, while the physical world kept moving without permission. Silver didn't crash $42 because the market was broken. Silver crashed $42 because the market was working. It was shaking out the weak hands, loading the spring, setting the trap for those who confused a paper price with a physical reality, and for those who understood the difference, who held physical metal through 52 hours of manufactured uncertainty, who read the vault data and the Shanghai premium and the QOT report and the geopolitical signals and made decisions based on documented probability rather than manufactured fear. Sunday evening was not a surprise. It was simply the answer. This has been Currency Archive. If this analysis reached you before Sunday's open, and you made your decision based on data rather than fear, then this channel did exactly what it was built to do. If you are watching this after the fact and wondering how to position yourself for what comes next, the data is still here. The vaults are still draining. The Shanghai premium is still real. And first notice day is still coming. Subscribe to Currency Archive because the next setup is already building.